To be truthful, I know of no strategy available today to underwrite conservatively and still be able to buy.
Good evening, everybody, and welcome to the Multifamily More virtual mastermind. I am your host, Jamie Gruber, along with my always dapper co-host, Benoit Malige. Ben, say hi.
Hello.
How
Hi.
are things?
Great.
Good. You look like you're in a cave right now. What's going on?
No, I just moved into a house. This is a garage that I have inherited with a bunch of stuff I need to get rid of.
Gotcha. That's right. You moved, what, about 2 weeks ago?
And something like that, yeah.
Yeah. Ben is growing up. He's growing up right before my eyes. So it's good. It's good to see. It's good to see. For those of you that are live tonight, what I would ask that you do is, as we go, drop questions in the chat box. You can use the Q&A box as well, but the chat box is just easier. I would just ask that you change the to everyone as opposed to just panelists, so everyone can see the questions and comments. And I will, as will Ben, pull questions out for Neal and get them rolling. If you are not watching this live and you're watching the replay, right down here you should see a subscribe button. We'd love for you to do so. The more subscribers we have, the more content we can deliver to you. So I appreciate all of you subscribing on the YouTube channel as well as on our podcast. Give us a rating and review, drop some comments. It helps with engagement on our channels, and we really do appreciate that. In fact, even if you're live, you can go over to youtube.com/multifamily and more and subscribe at any point. Again, we appreciate the support. So with that all said, Ben, did I forget anything? Did I get it all?
Oh, frozen.
Oh, Ben froze. All right, I got it all. He'll be back. I'm gonna introduce our guest. So Neal Bawa is known as the mad scientist of multifamily. He's a technologist and entrepreneur in love with the power of numbers to create profit for his real estate investors. He is the CEO founder at Grow Capitus, a commercial real estate investment company. He acquires commercial properties across the U.S. for over 800 investors. Current portfolio is 1,800 units, over $150 million in value. That's incredible. The portfolio includes multifamily, student housing across 9 states, multifamily and student housing across 9 states. He's also the CEO at Multifamily U, an apartment investing education company. He is a top-rated speaker. That's no joke. At conferences and events across the country. And I'm sure at this point, more than 5,000, this says nearly, I'm going to say more than 5,000 students have attended his multifamily.
We're over 10,000 at this point, and actually over 300 million on the portfolio.
This is a dated, how did I get this bio?
Yeah, throw it away, just toss it.
So double everything I said. That's Neal. Neal, welcome to the program. Happy to have you.
Thank you. Thank you. I'm really happy to be on the show, and actually happy to see a bunch of people that I've met last week. Christine's on there. Daryl's on there. Hey, guys. Great to see you.
We got some pretty cool people on there. I see some names with some units as well. Some investors, big investors are on there. So that's awesome. So Neal, I gave I guess an old bio of you. Why don't you give us a little bit more about you, folks that may not be as familiar with you? What's the story of Neal Bawa to this point?
I think the story is that life, mostly life happens by accident, right? So I had no interest in real estate whatsoever. I'm a technologist, I'm a data scientist. And back in 2003, the founder of the technology company that I was running, the owner of the technology company came to me and said, you know, all of our landlords hate us because we were running a student, technology company where we were training students. And the students would just walk over the carpets and mess them up and, leave the doors open. So all the landlords really hated us. And so he comes over and says, I would like to just buy my own campus, but it has to be custom built for our use because we need classrooms of a certain size. So would you be interested in building a campus? And I said, I would be interested, but I don't know anything about building campuses. I don't know anything about real estate. The only thing I own is my own single family home. And he said, no, you'll figure it out. I'm going to give you this awesome retired general contractor. He'll work with you. Plus he was a genius himself. The CEO, he knew so much stuff. So we basically went through this process and built a campus from scratch, right? Most people start with single family. I started in reverse with a $6 million new construction commercial property,
First
right?
deal.
I mean, talk about walking, walking through fire. I mean, it was
Wow.
ridiculous. And we were running our business from 8 a.m. to 6 p.m. And then from 6 to 2 a.m. in the morning, we were designing and building this building. So it was absolute insanity for a year. But by the time I was done, I was absolutely in love with real estate. So that's how it all got started. And I ended up building or partially building 6 other campuses in California before we sold our company in 2013. So it was just a labor of love and an accident.
Yeah, well, a good accident, it looks like. So you obviously have gone downrange on all things real estate. To your point, you fell in love with it, and you've become known for many things. That's what's crazy. As I studied you to try to figure out what lane do we go down in this. I mean, we'll talk about the markets. That's where we're going to go in a second. But man, I mean, we could talk about how you do virtual assist syndication. I mean, there's so many things that you've been involved in. Student housing is unique unto itself. But let's talk about the markets for a second, or the market for a second here. So I've heard you talk about, cap rates being flat across like all C class across the whole country. I've heard you talk about these dynamics that are out there right now that I'm not gonna label them other than they're interesting points. I'm gonna let you explain why they're interesting and how they're interesting. But what is today to you? What is the market, the multifamily market to you today? What does it look like? And kind of where do you see this going? Big question.
I think the right word for today's market is unprecedented bizarreness, right? So what today's market is something that if in the 70s or 80s or 90s or the 2000s, if you had people that knew what real estate was all about and you told them that a market like today could exist, they would immediately call somebody to walk you over to a mental institution. Immediately. I mean, there would be no doubt in their head that you could only be a nut. A market such as today's should not exist. The fact that it exists by itself is something that scares me. And what's amazing is that not only does it exist, it appears to be stable because it's actually existed in this current form since 2011. And I have to tell you, even though cap rates have gone down a lot and prices have gone up today, in 2019 and 2020, the market is actually more stable than it was in 2012, which again sounds odd, but is actually true, and I'll explain why. But this unprecedented bizarreness is because starting 2008, real estate detached. So the way I look at real estate, whether it's single family or multifamily student housing, really doesn't matter, is I look at it as 2 kinds of phases. One phase is the 1,000 years before the year 2009, and then 2009 to now, right? So apartments have existed for over 1,000 years. So there were apartments or rich, some of the kings of England in the 11th century became kings because their grandfathers had apartment complexes in the 10th century and got so fat and rich that they overthrew the king of England, right? That's how long the history is. And for all of that time, there were a bunch of rules that stopped applying in 2009. And in the last 10 years, those rules have not applied. And the reason that those rules don't apply today is today, the apartment industry is not about just supply and demand. Obviously, supply and demand matter. They still matter, right? So a market that's oversupplied is still going to have rent drops. But is it going to have price drops? I haven't seen any evidence of that at all, right? Why? Because of something that the Federal Reserve, not just of the US, but of the world did in 2009. In 2008, late 2008, when we saved our economy with quantitative easing and all the stuff that we did, bailouts and all of that stuff, the Federal Reserve found a tool that they never expected to use. They found that they could cut interest rates almost to the zero bound and not have any short-term negative effects. I'm pretty sure there's long-term negative effects, and we're seeing some of them now. But they found that they had this Bible, this gospel that the Federal Reserve had. And that Bible said, if you drop short-term interest rates close to zero, the world will end. Okay? And then in 2000, when they were 5 days from the meltdown of the world economy, they finally said, what the heck, it's going to melt down anyway. Let's just drop it to zero. Right? And they did it. And they did it very, very rapidly, right? Like week after week, dropping interest rates. Nothing bad happened, right? In fact, the world economy actually recovered, bounced back. And as soon as we did it, the Europeans were like, that seems like an interesting idea. We're going to try it too. The Japanese tried it too. And then everybody tried it, right? There were 1,600 interest rate cuts between 2008 and 2016. 1,600 interest rate cuts. There haven't even been 1% of that many in the preceding year before that, right? So when you look at that, it was a completely different way in the world, in the way that the world did monetary policy. It changed everything. And what it did was it changed real estate, right? It changed real estate because by dropping interest rates continuously down close to the zero bound, the gap between what real estate makes and what money in banks made was pulled, was stretched. So we became vastly more profitable even though our prices were going up, right? So imagine our prices are going up, but still the profit is going up. Why? Because we went from having interest rates at 18% in the 1980s to interest rates being zero today. So you go to a bank and you put money in, you make zero, right? And if you buy a treasury bond, you make about 1.5% over the next 10 years. If you buy real estate, you might actually make 15% in a single year. Imagine how big of a gap that is, right? So I could make 150% in real estate in 10 years, or I can make 1.5%, right? It's just ridiculous to see those kinds of crazy numbers. So the real estate is 5x or 10x more profitable, even if it's becoming less profitable every given year, which certainly is happening, right? I certainly can't create the profits that were possible 3 or 4 years ago. And a lot of people are like, but Neal, how is it possible today? We've got the lowest cap rates in history, right? Absolutely the lowest cap rates in history. And we're having these low cap rates when we have this amazing Goldilocks economy, 3% unemployment, 24 million jobs being created. How could it ever continue? Isn't this perfection? My simple answer to that question is, no, it can actually, they can go lower. Why? Because in the same time that cap rates in the US went from being 7.5% to 5.2%, that's a 2.5% delta in cap rates, right? 7.2 nationwide, 7.5 to 5.2. That's where they are today, right? About 5.2. That's about 2.3 points of compression in profits, correct?
Yep.
You know that interest rates in that time declined by more than 2.3%?
Yeah.
So the gap, the profit gap between what real estate makes and what bonds make is actually higher now than it was 5 years ago, which is why it's very difficult for real estate to get cheap. Because there's all these people around the world, these pension fund managers going completely insane thinking, how am I going to make money? 40% of my money is supposed to go to bonds, which are either at zero or negative. Then I have this 60%, which is risk assets. And I used to put those in very low risk assets, but I can't do that anymore because if I don't make more money on those assets, I'm not going to be able to pay my pensions. And so guess what they're doing? They look at around and they go, well, there's no way to make more than 2 or 3% anywhere. But if I take my money, and these are Europeans and Japanese folks, and they're saying, if I put this money into commercial real estate in the United States, I can get 6% cash flow on day one. And I can probably double it by the time I exit 5 or 10 years later. So I'm going to make 12%? Really? There is such an investment in 2020 that exists where I can go to the United States and make 12%? Oh my God, how do I get there? Right? And they're saying that now when we have by far the lowest cap rates ever in history. We have a market that for us is priced to perfection and should just freaking fall apart. But it can't because there's all these dudes all across the world looking at us as if we're the greatest thing since sliced bread. Bizarre.
It's interesting. That's it. And Ben, do you happen to know any European folks that are looking to deploy capital in the U.S. because there's a better return here than anywhere you can get it?
Just a little bit, yes. Yes.
There's a gazillion of these guys. I mean, they're desperate, right?
True.
Yeah.
And what's amazing is if you think, well, they could go to other places, Neal. Well, I encourage you to look at the current prices in Canada, Hong Kong, Singapore, India, China, and then look at our prices in comparison to our incomes. All of a sudden, we seem like the cheapest ones out there.
It's fair.
Right? You look at where the Singapore market is. You look at where Hong Kong is. You look at where London is, even after a 30% price reduction because of Brexit. It's still far more expensive than us. Have you tried Vancouver? Have you looked at Toronto? These are crazy markets compared to where we are. So it's, again, by itself, today's real estate market is ridiculously overpriced. When you look at sovereign debt and what banks are doing, federal banks are doing to somehow be able to pay that debt back, which is keep lowering the interest all the time, then it doesn't seem overvalued at all, because it's really where it's always been, 3 or 4% higher than bonds.
Makes sense. Like you said,
Nothing's
the profit margins are lower, but they're the greatest gap between.
The gap is all that matters. The gap is all that matters. Yes, we're making a lot less, but they're making a lot less too. The gap remains. And as long as the gap remains, we'll do okay.
I love that. And it's just a reminder, like that was, I got a couple questions I want to throw at you. Ben, feel free. But for the folks out there, as you're hearing this incredible information, make sure you drop questions in so I can drag them out and get them to Neal. So, all right. So you mentioned, and you mentioned today's market as we are, right, is, not as overpriced or not as crazy. Well, it's bizarre, like you said, but it's not as overpriced as some other markets around the world.
Yep.
And I think you said at one point, it really can't, what was the phrase you used? It can't, fall apart. Maybe I'm putting words in your mouth a little bit.
It's difficult. There's almost, of course, it falls apart every year, and it starts to fall apart, and then the money comes in, and so the capital on the sidelines that's sitting there is so gigantic in scope compared to the size of our commercial market that it's building a foundation under us that really shouldn't exist given how expensive we are.
We see it in Detroit. I'm in Michigan, and in Detroit, you see so much outside capital, foreign capital coming into that city itself. Local people don't invest in Detroit. So, right, it's all international. So what does...
I want to give you an example, by the way, of just how bizarre the world is today. Okay, so, here we are in the US, we're celebrating sub 4% interest rates today. If you want to buy a 30-year fix, you can get, you could probably get 3.75%, right? And we're like, my God, this is low, right? I want you to Google the following words: Danish bank offers mortgages with negative interest rates. There's a bank, a big bank. It's the second largest bank in Denmark. They're currently offering mortgages, a 10-year mortgage, at a rate of negative 0.5%. You know what that means?
No.
If you get a $400,000 mortgage,
you're also getting paid.
You don't even return all the principal. There is no interest. You actually get to keep some of the principal. Crazy. So on a $400,000 loan, you would actually end up only returning $396,000. And it's, by the way, it's not some gimmick. It's not some limited time thing. Anybody that's in Denmark can actually enjoy this. And you say, how can the bank make any money? Well, they're still probably charging you some fees, some points, right? So there's a little bit in it for them. But the biggest reason is they're picking up the money from the market at minus 1.5%. And then they're giving it to you at 0.5. This is known as arbitrage. 1% of $400,000 is still $4,000 in profit. So today, we have a world where you can actually get mortgages for free outside the US. Well, all of a sudden, we look like the best looking pig in the pigsty.
Interesting. So what does change the market? Everybody's talking about a coming recession, right? Oh, it's coming, it's coming, it's coming. What does it? Is it a black swan event? Is it a presidential election? Like what changes the U.S. market globally, if anything? Or what do you see coming?
So in my mind, the definition of a black swan event is nobody can ever predict it, right? So that is the in fact the definition. So in my mind, right now it has to be a black swan event, but it's actually more predictable this time than it was in 2008. This whole concept of collateralized debt and all the stuff that happened in 2005 and 6 and wrapping up those collateralization things, nobody could have dreamed that up, right? So other than the insiders who knew, if you watch that movie, right? Nobody really could understand it. But now it's very clear that there are clear potential black swan events, right? So, Japan's had zero interest rates for almost 20 years. There's all kinds of crazy stuff happening there where they're basically buying all of their own debt, right? So, they create debt and then the central bank buys it. So obviously this is a Ponzi scheme, and they call it a Ponzi scheme. Everybody knows it's a Ponzi scheme. So at some point it has to end. Well, that's a black swan event that's guaranteed, but I don't know if it's going to end today or 20 years from now. Don't know, right? Brexit is causing problems. The Eurozone has its own problems. Italy has more bad debt today than we had in 2008. So that by itself is a potential. Now, do we have a current black swan event in the US? No, unless it's a 9/11 type event, I think that we're in a very good place. So if there's no international black swan event that takes us into a global recession, the likelihood that we will have a recession the next year or two are actually very low. And the reason for that, once again, is we look to be so much better than the world economy that there's this support under us that is holding us up, even though our economy should have fallen apart by now, given that we've had 8 or 9 years of expansion. So I don't necessarily see a recession coming, but if it happens, yes, it'll probably be some sort of a black swan event, connected to something that happens outside the US. So okay. If it happens, I mean, I have all kinds of interesting predictions for what happens if it does happen, if the recession does happen.
Can we hear a couple?
So the chances that the next recession is as bad as 2008 are actually pretty low. Statistically, 2008 was a once in 100-year perfect storm. The chances that the next one's the perfect storm is actually low. The one after that could be, right? Because so at this point, I think the world just goes into a typical vanilla, recession. A vanilla world recession's a year long. Our recessions tend to be 9 months long, 3/4 of GDP. And we go into that recession. Real estate gets hit for sure. I mean, anybody that thinks that real estate will not get hit in a recession simply has lost their memory of 2008 or 2001. But typically, not as bad as 2008. 2008 was just crazy because there was no liquidity in the market. 2008 started as a real estate recession and then turned into a liquidity recession. Now we can't have that anymore. You notice that the Fed is very quick. Even if they sense something bad happening, they flood the market with several $100 billion of liquidity. So they move very quickly compared to where they did before. So liquidity is not an issue, and that's really what real estate people are really afraid of. But will prices go down? Yes. Will they go down across the board? Yes. Will they go down 30%? That's very unlikely. Might go down 10%. But some of these properties that are over leveraged will still start to go into default at negative 10%, -12%. So you're going to see a significant number of defaults, both in single family and multifamily. 2008, it was mostly single family. This time I expect it to be both, because multifamily now is leveraging everything up to the max, and prices are so incredibly high. Here's what I do expect though. A recession starts, 6 months later, the Fed's already cut interest rates. We're at 1.75% in the Fed funds rate. They cut it to 0, right? And so now that causes the recession to end. When we come back out of the recession, this time, because the Fed's playbook is known, the recovery will be much faster than it was last time. Last time we started recovering mid-2009, and we didn't really get into a hot real estate market until 2013. So it took about 3.5, 4 years before it was like, real estate is hot, everybody should buy, right? Well, I expect that to happen in 6 to 9 months, because everybody now understands that if you cut interest rates to 0, it's going to cut 10-year mortgages to 2.5% or somewhere in that range. And that's just insane, right? So they're going to start buying again very quickly. So I expect the pain for real estate in the next recession to be much shorter than the last recession.
Interesting. Okay. One quick clarifying question we have in the Q&A, and then the second question in there is actually what I wanted to ask. But the clarifying question is, can you just define a black swan event for our listeners?
A black swan event is an unpredictable event. The best known example of black swan is 9/11. So it is an event that hits the world economy extremely hard. They have occurred from time to time. The 1970s oil crisis was not predicted by anyone, really. And so it came in and it hit the world economy phenomenally hard. You can also have a positive black swan event. So the internet boom in the late 90s was a positive black swan event, right? By their very nature, you can't predict them before they happen.
I hadn't thought of that. It's a good point, a positive black swan event, but you're right. The .com thing was huge. So, all right. The other question was where I was going to go. And the question basically is, how do you stress test properties that you're underwriting? And that's kind of, the bigger part of the question for me is like, okay, I completely understand what you're saying. So do you buy, and how do you buy to ensure that whatever may come or doesn't, not ensure, but the best of your ability, ensure that you're protecting yourself and your investors against whatever could happen in the next 3 to 5 years or 2 to 3 years or whatever. Like, can you give us kind of an idea of what you're?
And while we're at it, sorry, I'm just piggybacking on another question. If we can compare single family homes to apartment investing at the same time.
Okay, sure. Yeah. Do you
Sounds
see any
good.
difference?
I like Kara's questions as well, so I'm going to definitely pick up on her question there. So I'm going to give you a really horrible answer. I think that this is going to to be truthful. I know of no strategy available today to underwrite conservatively and still be able to buy.
That's a great
The
point.
two options today, there are only two options. And people will tell you all kinds of bullshit. I have found some magical way to underwrite. I have some magical cachet of off-market properties that where all of the sellers, all of the owners are total idiots and don't know the value of their property. So they sell it to me at 10 or 20% under market. I think everybody that's telling you that is either lying or is delusional. So the only way to buy properties today is to be aggressive. Okay. And I am not exempt from that in any way. So I'm aggressive because clearly I'm buying properties, right? You go to my website and you see I'm buying properties left and right. So you might say, so Neal, I mean, if you're not conservative, then why are we listening to you? Well, the answer is there's more to it than that, right? So either I can sit on the sidelines or I can be aggressive. But then if I am aggressive, then there are still tools that I have to make sure I hit my returns. Tool number one, I'm coaching my investors that returns are going down. So each successive property value add that I do, the returns that I'm showing them and the pref that I'm giving them is lower. Just go to my website and take a look. We have gone from 22% down to under 18%, right? So number one, I'm coaching people that there's lower returns because I'm paying up. What I'm not seeing in the marketplace, which I have strong objections to, Jamie, is I have people that were buying at $60,000 a door and offering 22% returns. Now buying $80,000 a door and offering 22% returns. That's bullshit.
It has to be.
Nobody can do that, right? You're paying up, right? And their excuse is, well, interest rates are lower, but you're getting a bridge loan, aren't you? How can you be sure that they're going to stay lower, right? So you just make the best case assumption. So then you're not conservative. And if you're not conservative, then that's what I'm pointing out. I'm saying that you're not being conservative. So number one is get your investors in the frame of mind that look, in rates are lower. And I know that's painful. And that's why I'm on podcasts like this to build up my brand. So my investors trust me and say, you know what, I think this guy knows what he's talking about. Yes, he's offering me 2% lower than everybody else, but that's just 2% theoretical. Maybe in practice, he'll make as much or more than the other guys. That's my hope. And so far that seems to be holding up. That's number one. Number two is, you can have strategies to increase the value of your property far, far beyond what is typical, right? So there's a guy named Paul Peebles. He recently did a podcast with me on it, and apparently it's one of the most popular podcasts he's ever had. In this podcast, I sort of opened up and said, here's 10 different ways in which I generate money that I've never seen anybody else generate. So if you want to listen to a whole podcast filled with ideas, crazy ideas, admittedly, involving 4K cameras and tracking pets and getting extra pet fees, stuff like that, and how profitable that is, I give you all the math in that podcast. Go watch Paul Peebles' podcast that I've done. It would take an entire podcast to get into that. So number one, there's ways to increase revenue that is not typical, right? Number two, there's a second way to increase revenue. Houston is a market where occupancy is at 91%. Provo is at 95. Dalton, Georgia is at 98. Therefore, different markets stay at different levels of occupancy. What if just your buildings could be 3 or 4% higher than the market occupancy, right? Wouldn't you do well and exceed your pro forma?
Absolutely.
Well, the way I do it is I simply have an army in the Philippines. It's a very large army, 17 full-time employees. They all work 10 hours a day. And there's a call center, which generates about 30,000 tenant leads a year for my tiny little portfolio, and then processes those 30,000 tenant leads in real time as leads are coming in to schedule 4,000 tenants at my property. That's 4,000 tenants more than this property had the day that I walked in through the door, correct? Or not 4,000 tenants, but tenant prospects.
Prospects. Right.
Isn't that the creation of revenue? All I have to do is go from 93% to 96 or 97. The delta, that 3 or 4%, if you understand multifamily, that delta is incredible. Yes, Kenneth, I am talking about LASL. So Kenneth is pointing out that there's a podcast of mine that talks about this infrastructure that I've created in the Philippines. If you type in Neal Bawa LASL, you'll see a podcast on how to create these kinds of unique systems. So now, number 2 is create unique systems. Neither one of those two will fully protect you during a recession. So during a recession, I have a completely separate strategy. And that strategy is don't give my investors any money. It's a terrible strategy, sounds terrible, but it's actually very powerful, because as long as we don't have a recession in the US, my job is to make my investors money. The moment the Federal Reserve declares a recession, do you know that I don't no longer have that job? My job now is to protect your capital, is to prevent you from losing money. During a recession, there's only one thing that matters. Don't lose your investors' money. Forget about cash flow, okay? Because right now you're fighting to make sure you keep the property. So there's a strategy that is not public yet, but in a week, you can go to my Facebook page, Magic of Multifamily. I've created a new strategy. It is called War Chest. It is a 4-step strategy on what the heck you should do when a recession begins. That, I think, is the most powerful of all the strategies, because the biggest mistake that multifamily people make is when a recession starts, they do the same things that they were doing in a good economy. No, you're actually shooting yourself in the foot. The vast majority of those things are bad, right? We talk about rehabbing units and increasing rents, correct?
Mm-hmm.
But here's the problem. If you were to simply clean up the unit and rent it the next day, the unit's down for 2 days. If you're rehabbing it, it's down for 4 weeks. Well, you're not going to get any value for that money during a recession because there's a million units open to that tenant. So he's not going to pay you this delta. So the worst thing that you could do is rehab units in a recession, but that's what we saw last time. The war chest strategy has 4 pieces, and one of them is stop all rehabs, right? So watch that strategy. The key is to basically know how to get through a recession, bottom line. And then the last piece is bridge loans. A lot of people think bridge loans are bad. I think in today's environment, you simply do not understand macroeconomics if you think bridge loans are bad, right? Today, the worst kind of loan is a 10-year fixed. Absolutely a horrible loan, because the world environment doesn't allow interest rates to rise. And then you have populist politicians like Trump who are asking for 0% interest rates. Please Google Trump asks for 0% interest rates. Is he the only one? No. The guy in the Philippines that's like him has asked for it. The guy that just got elected in England is a populist PM. They're all asking. They're all saying, let's just keep taking interest rates down because it keeps making the asset bubble party bigger. So today, the macro environment doesn't really allow for interest rates to go up. If that's the case, why the heck are you doing 10-year fixed? You're really hurting your investors.
Very interesting. Very interesting. There's a lot there, but there's a couple questions. You mentioned Cara Kennedy had a question. Assuming your commercial multifamily is leveraged conservatively, is there validity to the statement that as long as you can handle reduced market rent rates, that multifamily investments are more stable than single family homes?
So the way your statement is written, Kara, assuming your commercial multifamily is leveraged conservatively, the answer is yes, they are more stable than single family home, assuming so. However, today's reality is that no one is leveraging conservatively, including me, right? So your question is hypothetically yes, practically no. At this point, I think that the risk to multifamily is quite significant. Is it more than single family? No. Throughout history, including 2008, multifamilies have never defaulted at a rate close to single family. It's always been higher. But having said that, speaking just in terms of comparison between single family and multifamily risk, I think if single family was here and multifamily was here in 2008, today, if a recession starts, you're going to have single family here and then multifamily closer to 2008. So big, why? Because it's a lot more expensive. I mean, the average price per door is up 60 or 70%.
Crazy. There's a lot that you would, I just love the idea of strategy shifting and educating your investors. That's what I heard, at least, right? You're coaching your investors on.
It's a 4-step process. Let me just kind of give you the one version of it, right? So I mentioned war chest, right? So the number one was stop doing rehabs. Number two is create a war chest. So stop giving your investors cash flow. Put 3 months of interest, mortgage interest in your bank in a war chest, and then start again, right? Number three, do chatty Cathy. The strategy is called chatty Cathy. Double the number of times you're talking to your investors. There's nothing wrong with investors continuing to invest in recessions. They just are more anxious. They'll keep giving you money as long as you're talking with them more often. Oh, there's my son. Hello in the background. I love this room, so I always do podcasts from here rather than the small rooms that
All right, I have kids that have to scream at different points of the night.
So, and then the fourth strategy, let me think about what the fourth one was. Oh, yes. So in our world, leases longer than a year are considered to be bad because you want to raise rents each year.
Right.
When a recession starts, you want to do the reverse. You want to offer tenants 18-month leases because you don't want turnover.
That's
right?
expensive.
You do these 4 steps and you'll get through a recession because the Federal Reserve of the bank is going to gift your property millions of dollars during this recession by dropping interest rates by almost 2 points. They will gift you millions, but your building had still be there at the end of the recession for you to get to reclaim your gift. You know what I mean?
I do.
So
yeah.
You're going to suffer first and then you're going to enjoy the benefits. But make sure that you are ready for that suffering.
Incredible. I love that. All right. So a question we have in the Q&A. The question is, I don't think you touched on this, but do you see negative rates coming to the U.S. or is 0% the floor?
So if there's a black swan event that is like 9/11 or worse, I see negative interest rates in the U.S. But if there is a vanilla recession, the Fed, I think, will stop at 0. Going below 0 for the reserve currency of the world is a very bad message to send. Others can do it, but they don't happen to be the reserve currency of the world. The reserve currency of the world is an extraordinary privilege and also an extraordinary burden. For us to go negative is highly dangerous. It's easy for Japan or Germany to go negative, and they already are. Mm-hmm. So for us, we would only do it if there was a worldwide crisis, in my opinion.
Understood. All right, there's another question here. I'll throw it out there. I think you kind of touched on this, but what are your thoughts on heavy value add properties with less than 30% occupancy?
I think most people that do them fail. I just want to say this. Most people that do them fail. They are highly dangerous because their occupancy has dropped to this level where you're going to need to bring the property up to 2020 code. If you do the math on how much that costs, you're probably just going to go build another property. So in my mind, they're highly dangerous unless they're small. So if they're like a 20 unit, it's different. But, I see people doing 100, 200, 300 units with 30% occupancy. I simply do not believe that they understand the risk that they're taking.
That's fair.
It's a completely different level of risk. If investors are not making 50 or 60% annualized, it's never worth an investor's money.
Okay. So a question I have after talking through all of that makes a ton of sense. It's a lot to digest, maybe for the small brain that I have. Especially.
I'm kind of fire hose in my style.
Not at all. Not at all. Meaning there's so much content packed in there. And I think you're doing a great job, honestly, of laying it out very logically. I've got a page worth of stuff written down already. So, but for you, what are you looking at in submarkets? Like what submarkets do you look at? What dynamics do you look at? Are you only in places that have, the Texases and the Southeast, like the high growth, high population growth markets right now? Or do you look at things a little differently maybe than the masses at this point?
Pretty much the same as everybody else. There's nothing wrong with high population growth, high income growth, and high job growth. But I typically tend to look for suburbs. So my favorite markets right now are Raleigh and Charlotte, and Raleigh more so than Charlotte. But I'm not looking to buy in Raleigh. I'm more interested in Durham. I'm more interested in markets outside Raleigh. Another market that's very high growth, very high rent growth is Phoenix. I have no interest in Phoenix, but I have interest in Mesa, 20 miles away. So what I tend to do is to look at high growth markets and then look away from that. I don't have a property in Dallas, but I do have a property in Fort Worth. right? So my feedback is the suburbs are are a better bet in high growth markets than the market itself, because then you're paying up so much more that you're basically not getting any benefit of that growth, of that, you know, of the job growth or the income growth, because you've already paid too much upfront. Kara, that is correct. So Paul Peebles has a podcast. So if you Google Paul Peebles podcast, you'll see it. You know, go to that page and search for my name, and you'll see the podcast. I think you can look it up on iTunes.
Waterville Capital. So, all right, on that point then, so you're looking in the suburbs or outside of kind of that growth population, or that area that's growing in population. What asset, like, are you comfortable going into an A-class, fully stabilized asset and kind of riding it, implementing some of the things you talked about for value add, or are you looking at that B, C class? Are you avoiding C class because of CapEx? I'm kind of curious, what asset class are you most targeting, or is it all of them?
So as syndicators mature and they get bigger, they tend to move away from C's, and I'm in the process of doing that. So I tend, you know, the last property I bought was more of a B. I am not interested at all in buying A's and implementing my strategies. No, that math never works. I'm interested in constructing A's, but only in high growth suburbs. I'm not interested in building a property in Phoenix, but I'm building one in Mesa. I'm not interested in building one in Raleigh, but I'm building one in Durham. So to me, those high growth suburbs, it still makes sense to do new construction. A lot of people are like, new construction is really risky. Really? Okay. New construction is risky today compared to you buying a Class C for $100,000 a door? I mean, come on. Those things were $50,000 a door 8 years ago. What's changed that much? People's income didn't double, right? Look at that risk. Right. So, I mean, literally, people are paying $100,000 for Class C properties when you can build new ones for $130,000 or $140,000. So that math isn't making any sense to me either.
That's interesting. Very interesting. I've got a couple other things, but Ben, I know you got tagged out there for a second. Anything popping up for you? Any questions that you have?
No, I'm seeing. I lost all the questions when I came back. Seeing new questions popped up, but I'm just. Yeah. Can you guys hear me? Yeah. I'm just like taking it all in. This is just great. I don't have anything to add personally.
I have a macro question, so I'll take that. So Subra says, currently we have an inverted yield curve, which is considered as a good metric to measure a downturn, and we're not in a recession. So can you suggest a few metrics that we can use to identify if the next downturn is coming? So firstly, the yield curve is currently not inverted. The yield curve is inverted and then almost immediately uninverted. But it's not the yield curve staying inverted that is the forecast of recession. Simply the act of inverting once that forecasts a recession. So the fact that it's uninverted doesn't do us any good. It is a warning light. Keep in mind though that I've followed the yield curve before. It's inverted a number of times before where there was no recession. So it is not some magical thing that says a recession must show up within 18 months of a yield curve inversion. No, I mean, just go back and Google this stuff, right? So it's an indicator. Is there a better indicator than the yield curve? No, one doesn't exist. Because recessions occur for hundreds of different reasons, no one has invented a magic box that shows, you know, when the next downturn is coming. So I can tell you this. I would know, based on years and years of research, if there was a reliable indicator of a recession. If such an indicator became public news, it would then become worthless because too many people would know about it. Keep in mind, if too many people know, an indicator does become worthless because their actions change the future. So bottom line is no such indicator exists.
Interesting. Okay. We do have a question in the Q&A I'll get to in a moment, but I wanted to touch on this because at least on this old bio and what I've seen of what you do, you've ventured into the opportunity zone investments, correct? Can you dabbled? Okay. Can you first at least give a brief overview of what that is for folks that may not understand what an opportunity zone is, but then talk about that in the context of what we're discussing. Is there an advantage to looking at opportunity zones in the current market, or is it really no different than any other asset class that you would look at?
It's actually worse. So in general, opportunity zones are far more dangerous than looking at a general new construction. Keep in mind, 99% of opportunity zone projects are new construction because You can't buy a value add in an opportunity zone and take advantage of the benefits, because you'd have to improve it by like $50,000 a door, which is crazy. You'd never make any money. So I know of maybe one project which is being improved enough to qualify for opportunity zone benefits. What an opportunity zone is 12.5% of the United States right now is designated as opportunity zone areas. And these are basically areas that are underperforming compared to the areas immediately around them. So the areas around them have higher income, higher job growth, higher population growth, all those sorts of things. So these are depressed areas or underperforming areas. And the government is saying, well, I will give you these insanely large tax benefits if you go there and start doing new construction projects, right? Now, why are they giving you these insanely large benefits? Because you would really have to be insane to go into these places to do new construction. So it's one of those catch-22s. It's like, well, so you're asking me to build in a place where nobody would have, in his right mind, would have built anyway. So why do I care about my tax benefits if I can lose my principal? Right? So it's not taking off as quickly because a lot of people realize that these places were not worthy of new construction. Now, as it happens, roughly 10% of the opportunity zones in the US, there's 8,751 opportunity zones. I found about 300 of them to be pretty flawless. There's nothing wrong with them at all, right? So you kind of have to wade through a huge amount of data, and boy, it's taken us a long time. We've spent about 500 man hours to get to those 300, but those 300 are better. Why? Because I would have normally just picked those places to build something new anyway. And now I'm getting all this free money from the government, right? Like just huge tax benefits that opportunity zones enjoy, and no downside. So if you can figure out where those 300, opportunity zones in the US are, then they're great. Otherwise, they're terrible.
Yeah, we had another guest on. He's an accountant and an investor, and I mean, almost to the T of what you just said, he said the same thing. I think he even used a phrase like, "Why would I have the most beautiful house in a terrible neighborhood?" kind of thing. Beautiful property in a terrible neighborhood. But I hear more and more people talking about opportunity zones like this Frontier, and I don't look too much at it, but everything I have heard about it is akin to what you just said, that they're just a scary proposition.
Let me give you something that works a lot better. So let me tell you what doesn't work well in an opportunity zone. Multifamily, because people have to live there. Hotels, because who would want to build a hotel in a depressed area, right? Anything gorgeous, right? Anything that's good looking, that requires people to be drawn in, would not work well. But then think of some asset classes that actually could work much better. I am not in those asset classes. Think industrial warehouses. Wouldn't that be great to build in an opportunity zone? Underperforming areas are cheap. Land is cheap, so they usually do industrial there, right? How about storage units, public storage units, right? I don't want to live in that place, but I don't mind driving into that place from my better area that's a mile away. If the public storage is brand new, it's gated, it's got cameras, and I'm just driving my car straight into my public storage unit anyway, right? Mm-hmm. So in my mind, all these new crowdfunding portals that are showing multifamily, new opportunity zones, that's missing the boat. You got to basically do the kind of asset classes that you can do in lower quality areas anyway. So in my mind, in general, if somebody does 10 industrials in an opportunity zone and does 10 multifamilies, the industrials are going to beat the crap out of the multifamily in terms of returns.
Makes sense. That makes sense. And I'm starting to get the hint as to why they call you the mad scientist here. So this makes a lot of sense. We do have a question from Ken regarding the heavy value add property on a 20 unit or under. At what occupancy rate would you draw the line and not touch? Interesting.
That depends on how leveraged you are. I mean, obviously you bought this property, it's completely empty or mostly empty, so you're going to be bleeding. So on a 20 unit, I would say I would go all the way down to 0% occupancy if I had enough cash flow. And I could take my time. So it really is about that. I would not give you the same answer if you said 200 unit. So on a 20 unit, it's small enough, I think, and you can get through the rehab quickly enough for it not to matter as much. So I'd go probably all the way to 0. On a 200 units, I probably would stay over 50%.
Okay. Now we have a question from Tyler in the Q&A. Let's see. What are your thoughts about increasing the accuracy of aggressive underwriting by ensuring you're buying a better class asset, say B or B plus, in a better submarket in a larger metro with good job growth, good population growth, and positive net absorption? All of these factors increasing likelihood of steady rent growths and cap rate compression.
Wow, that wasn't a question. That was a book. Well,
if you get that, I know you're the mad scientist. I'm not quite sure I get
it. So the question, I'm going to answer it simply as, if in a practical situation you can actually check all of those boxes off, could you please let me know where you're buying so I can follow you? It's impossible to check all those boxes off these days, right? I mean, if you get a good metro, you're not going to get a good cap rate. If you get a good cap rate, you're going to end up basically, buying in some shoddy place that really is not worth it. So how do you underwrite conservatively, get a high cap rate, and be in a really good market at the same time? Does such a market exist in the United States? I know one that exists, by the way, Puerto Rico. It's not in the US.
Yeah. Interesting. This is actually, I like this question. So there's a question about some of the national rent control policies out there. New York, California have capped rent control. I recently saw Seattle has limited evictions for the 3 or 4 months of winter. As an owner of property in New York, the law that was put in place itself does nothing to me, because it's more than I'm going to increase rents by on an annual basis. And I can actually, if I turn the unit, I can go to market rent. So it doesn't scare me, that law in particular. But what does it signal to you, or what does it mean to you, some of these laws that are out there?
I think in and of itself, Oregon, California, and New York, their laws were okay. The problem is that this is a trend. This is not going to stay with just 2 or 3 states. I know of a dozen states that are implementing. What's worse is New York, Oregon, and California are all currently working on follow-up laws that are far more draconian. So all 3 of these states, Democrats passed these laws, and now they've become emboldened, because once you get the concept of rent control accepted by the public, now you can basically pass more draconian, laws. Which one's going to pass them? I don't know. I know New York's certainly going to try to pass another slew of them, and so is California. California is actively at work on a second set. What I'm really afraid of is this nationwide populist rent control, drive. I can tell you, rent control does only one good thing, depending upon whether you're the candidate. It gets politicians elected. Yeah. That is the only benefit of rent control. On the downside, over a 20 or 30-year cycle, rent control puts hundreds of thousands of people out of their homes, because it drives up property value, right? First they tank, then they come back, and then they get drive up for a long time, because nobody wants to build in those markets, because nobody wants to be in rent control markets. And institutionals don't want to buy large properties in rent control markets, so they don't put a lot of money in. So over time, 30 years from then, you are putting hundreds of thousands of people out of their homes. You look at rent control markets in the US that are, San Francisco, Oakland, 2 of the most expensive markets in the US. They've had rent control for 20, 30 years. That didn't work. Mm-hmm. So in my mind, the problem with rent control is it's a populist measure. And we are now a country that mostly votes for populist folks. So you look at whether it's Bernie Sanders or Donald Trump, these are populism-driven politicians. Bernie Sanders, like, oh yeah, I'm going to forgive everything. I'm going to forgive this. I'm going to forgive that. And everything will be free. And Trump, of course, don't get me started on Trump, right? So when you see this, it is just scary as to where it could go in the future. Right now, it doesn't mean much.
Yeah, it's a signal. Like I agree completely with you. And even in the states where that law has gone into play, a cap on rent increases or whatever, like that law doesn't do anything really, but it's the signal of what the next law is going to be. The next law is going to be, right? So it's
never stops. These things don't stop, right? So it's going to keep going, unfortunately. So I tell people this, and I, believe in it. Basically, say I'm a liberal Democrat. Cut me, and I'm going to bleed blue. But I only invest in red states, because that's where I can keep my investor money safe.
Yeah, no, that makes sense. That makes sense. One last question I'm going to pop in before we start to wrap this. There's a few in here, so I apologize for those we didn't get to, but I am curious about your thoughts on Airbnb. Where you see that, do you leverage that at all in your portfolio, and what do you think the future of Airbnb is for a multifamily?
I do leverage it in my properties, but in my mind, Airbnb is saturated. A lot of people are not reading about this. You need to look at Airbnb articles on the web that talk about saturation. There's a very high level of saturation. I happen to know some phenomenal Airbnb hosts in multiple markets. These people are really good at what they do. They're better than most Airbnb hosts, and they're struggling because the number of properties being converted to Airbnbs is just continuous. It's just constant conversion, and the hotels have started hitting back. We've had 5,000-6,000 hotels in the US gone through renovations. The hotels have dropped prices, they've increased amenities, so that marketplace is doing fairly well for the moment. And so I would say there's an opportunity in Airbnb in certain markets. You should use tools like airdna.com and go into markets with a ranking of 90% or higher. But in general, the Airbnb market is very saturated, and one needs to be very careful. Everything saturates, right? I mean, there's no magic market. Why should Airbnb be magic?
No, that's a great point. It's funny, a little side story for me. I'm taking my family and my parents to Chicago. I looked at a hotel, 2 different rooms. It's like $900 for these 2 rooms for a couple of nights. Oh, there's an Airbnb for $600. But once I went in and saw what the city charges for fees and the cleaning fees, and it actually doubled. So it was $1,200 to stay at the Airbnb versus $900 at the hotel. To your point, hotels are hitting back. So, all right, we are at 8:57. I want to be respectful of your time. There's a couple other questions here I wish we could get to. I apologize for that. But you talked a lot about a few things that I want to make sure people know where to find it. So LASL, the war chest strategy, you talked about 10 different ways to, 10 different strategies to increase the value of your properties. What's the best way for people to sort of find that, how can you direct people to where you're going?
So we do dozens and dozens of data-driven webinars on multifamilyu.com. So just go to multifamily followed by the letter u.com, and that's a perfect place to start. The place that you should always start, especially at the beginning of the year, is right on the homepage is a big section that says the Trends Toolkit. Click on that, and you'll see astonishing amount of information. Somebody just asked about other asset classes, blah, blah, blah. We've got stuff about other asset classes that we're constantly adding in. Also, my Facebook group does these things called multifamily minutes, and the one that we posted today was a 2-minute detailed discussion on senior housing. So if you go to the Magic of Multifamily Facebook group, that's my Facebook group. It's the fastest growing multifamily Facebook group in the US. Magic of Multifamily. That we are constantly posting these kinds of events, but in small bite-sized chunks, because that's what people like more these days. 2 minutes, 3 minutes, 5 minutes on different asset classes. Sriram, just so you know, I am quite bullish on self-storage. So that's the answer to your question.
Good stuff. No, this is incredible. Like I said, so much great content, and I can't wait to post this so more people can view it. Ben, what's on your mind at this point?
I was just amazed by all the answers, so flawless and extremely.
Yeah. Do you spend, how much time do you spend a day just you mentioned Dalton, Georgia. I don't know if you know, you referenced Dalton, Georgia, and their occupancy or their occupancy at 98%. What do you, like 12 hours a day just studying the markets? How do you do this?
No, the short answer is that we spend a massive amount of time on virtual assistants who go out and do this research and present dashboards to me. So I spend maybe an hour a day on all the different kinds of research that I do.
That is a whole other topic I wish we could get into that is fascinating to me. How I've heard you speak about how you use VAs, your use of Upwork, systems and processes you've created with this, as you put it, army of folks in the Philippines, and you have a very, very, very specific strategy for how you onboard, how you hire, how you develop your VAs, and how you really maximize your output every week as a result of it. So incredible stuff, Neal. Thank you so much for being on tonight. Thank you for your time, everyone. Thanks for joining. Thanks for asking the questions that you did. And Neal, we hope to cross paths soon, and thanks so much again for being a part of this.
Thanks for having me on the show.
All right,
Bye-bye.
everybody.
Thank you.
Have a wonderful night. Thanks. See you, Ben.
Bye.
All right, bye-bye.